Episode 15. Don't pass out on me.
15, 1-5.
It's good, man. I like it. We're cruising through these.
Are we centered? Sometimes we're.
Find your center. Find your center.
I mean, I meant like in the photo.
All right, we're good. I have no idea. I'm just gonna roll.
Yeah.
It looked like we were.
I think so.
I'll do this
Okay.
one. Well, hello and welcome to the Lending Podcast again. We are here coming from you at the Broadcast Center of Austin, Texas at Benchmark Mortgage. This is JB, the guru of mortgage, and I am Jeff Jones. We are your hosts today to talk about PMI.
PMI, private mortgage insurance. Or is it MIP, mortgage insurance premium? Well, we're going to dive into that.
We're going to dive into that because we love acronyms as much as the next person. And they are all over our industry like any others. But
our entire business is built on acronyms.
Our entire business is built on acronyms.
Yeah. And they're all 3 letters.
And what's funny is we turn acronyms into words. So when we talk about Fannie Mae, FNMA.
FNMA. That's right.
Freddie Mac.
Freddie Mac.
We like turn acronyms into words.
True.
So PMI or MIP or just mortgage insurance or guaranteed fee.
We're going to unpack
they all
of
very
it.
synonymous.
That's right.
They're all mean the same thing.
Well,
So what is it? Let's start there. What is this thing that we're talking about?
In its simplest form, this is insurance that the bank requires the borrower to pay when there's less than 20% down payment on most programs. We're talking conventional loan. If you're putting 20% or more down, you don't have to have PMI. And so a lot of times we get the question like, should I wait to save up the 20% to put down so I can avoid PMI? So in some cases, perhaps that would be a good strategy. But we're gonna kind of bust that myth of why waiting would be perhaps the wrong decision sometimes because how cheap the mortgage insurance actually is.
And and it really kind of goes back to a very old concept of thinking that there's a loan to value. So what an investor wants to look at, whether it's mortgages or just private investing into a business, they want to see how much money the buyer is putting in, right? So it's their skin in the game. And when you put a loan together that's at 80%, you know that you have baked in a 20% buffer of risk, right? If everything goes wrong, at least 20% is secure.
Exactly.
The challenge with mortgages is 20% of the largest purchase of your life is a lot of money.
Could be a big
deal. PMI really exists at its core to make less risk for those people that are putting less than 20% down. So that actually, a lot of people think PMI is like an evil thing, and you still might believe that even after this episode. But it exists so that banks will loan more than 80%. That's the real reason.
That's right.
Otherwise, they might not have done it.
Yeah, and there was a stat recently, an article that I read where like 40% of a certain segment of buyers believe they had to wait till they had 20% to put down. Like we do loans at, there's 0% down loans, but mainly we do loans at 3 to 3.5% down all day long.
All day long.
And so if you're putting 3% down, as you said, that's a low down payment.
Yeah.
The bank sees that as a higher risk than putting 20% down, obviously. So they require our buyers to pay some level of PMI. Now, there are tiers of PMI. Okay, let's talk about conventional first.
Yeah, well, one real quick thing too is mortgage insurance still doesn't take away all the risk, especially for the borrower. So the mortgage insurance is not a way for you to back out of paying your loan. Right. So they will still foreclose on your loan even though they have mortgage insurance on it.
That's a good point.
So I just want people to realize I have insurance on it so I can skip a couple payments because they have payments, they have a nest egg of it. It's not true.
Yeah, that's a really good point. Yeah, the bank, obviously you're obligated to make those monthly payments. If you don't, the bank will foreclose. And mortgage insurance and homeowners insurance are 2 totally different things. We'll talk about that a little bit. But this mortgage insurance, this PMI that we're talking about, is specifically insurance that you're paying the bank that protects the bank in case you default. And then what it does is it actually provides a layer of protection, like you said, when the house gets sold. If there's a loss between what you owe and what the bank receives, the mortgage insurance company covers that gap.
Right.
So it could be 10-15% of the equity base in your home if the bank's not able to sell the house for what you owe. And so that's what protects the bank. Now, in recent years, the risks have gotten a lot less because our appreciation rates have been really, really good. So the banks are sitting in very good position loan to value wise. We as homeowners are sitting in very good position loan to value wise.
That and the
So
foreclosure rate continues to stay below 1%.
it's very
So
low.
it's
Yeah,
a good time for people to give out mortgages.
true.
So
Yeah, which just make the costs
yeah,
lower, because
right.
it's all aggregated based on
It's
risk,
all
right?
risk.
Lending always comes
All
down
risk.
to risk.
Okay.
So conventional loan, we're going to talk about 5 different kinds of PMI, and
5.
not everybody knows there's 5.
Okay.
So the most common one is monthly. Okay, so monthly PMI is going to be some kind of a factor based on your debt to income ratio, based on your credit, based on the amount that you're putting down, the type of property could come into play. If there's one borrower, 2 borrowers, 4 borrowers on the loan, right? So the bank's evaluating the risk, and then they're going to give you a certain percentage of the loan on a monthly basis that you're going to pay for insurance. The lower the risk, the lower the cost.
Right.
Okay, that's its simplest form. So we're going to evaluate that as the first option. That's the most common. The other 4 are less common, and they kind of raise their head at different times to be a better strategy depending on what you're trying to accomplish.
Hmm.
So the second option would be what's called a single premium. So you can actually buy out your mortgage insurance up front.
Up front.
And or maybe the seller can is giving seller concessions,
Right.
seller paid closing costs. You can use that money potentially to buy out your mortgage insurance. Again, this is on a conventional loan. We're going to circle back to FHA and USDA here in a moment. But conventional loans, the second option would be a single premium. It's a lump sum, and for the life of the loan, you will not have mortgage insurance because you paid it up front.
Right.
Okay. In a higher rate environment, it's not my favorite option always, but
Right.
it is maybe a tool to use to help you qualify as well. The third option is a hybrid. So it's called split premium.
Mhm.
It is some level of mortgage insurance up front as a single premium, and then a lower monthly amount. And we see this as a good strategy sometimes when the debt to income ratios are kind of tight. You're trying to qualify for a little more house. You need to bring down that mortgage insurance premium amount. We can use that as a tool to do that.
Yeah, and that's because the mortgage insurance premium is a part of the debt on your monthly payment,
That's right.
And if that piece goes away, then you have less debt, which brings a more favorable debt to income ratio,
That's right.
which we talked about on a previous
That's right.
episode. If you want to watch that one, you
That's
can.
Right. You could qualify potentially for more house by
Yes.
reducing the PMI, right, or
Right.
eliminating it. The fourth option, again, less common, but it's still out there, is called a financed premium. So you can take that single premium and actually tack it on to your mortgage in certain circumstances with conventional loans. So you're actually financing it over time. You don't have to pay it up front. You don't have to pay it monthly. It's a pretty cool strategy. In certain circumstances, it's not necessarily the best one, for everybody right now, right? But these are just all the options. And then your fifth product is called a lender paid premium, lender paid PMI. That's where we actually absorb the cost of the mortgage insurance premium. It's essentially a single premium. We are paying it on your behalf up front, and we're doing it through an interest rate increase.
Mm-hmm.
So the strategy there might be it's a shorter term house for you. You're only going to be here a year or two. You know
Right.
you're going to be moved, your job's going to move you or whatever. You want to eliminate the PMI, reduce the monthly payment. We're going to absorb that cost through the interest rate. It's not a huge number, through the interest rate, but it does affect the terms. So those are 5 options. Most of our clients don't know there's more than one.
Right.
But a lot of our referral partners don't know there's more than one. They just see monthly mortgage insurance, and that's it.
Yeah.
So there's several.
That's why we do these episodes.
That's why we do these. That's right. That's right. Yay, PMI.
Yay, PMI.
It's so fun. Okay. So that was conventional.
Yeah.
We want to flip over to government. Did we cover
I feel like we
everything there?
covered that pretty well. What I want people to realize really is, mortgage insurance, simply put, covers the lender, but gives you the option to not have to put 20% down.
That's right.
There's different ways for that to play out. And a lot of it, the biggest factor is how long are you going to have this mortgage? You're going to have it for 1 year, 2 year, 3 year, 4 year, 5 year, because that really will dictate the return of what kind of mortgage insurance we structure. So we didn't talk about how to get rid of it, but maybe we could talk about that now or the end.
let me touch on one more thing, and then
Yeah,
we can talk about. Okay,
yeah.
so a strategy. I want to use this success story
Okay.
for one of our clients. Okay, and this is a $500,000 property, and the buyer had the option to put 20% down, but chose to put 10% down. Okay, now the PMI, the private mortgage insurance, right, monthly mortgage insurance, was about $80 a month. Instead of putting the extra 50,000 down, this client decided to put 10% down, save the 50 grand in the bank, $500,000 purchase price, and the monthly mortgage insurance was $80. So round up, it's about $1,000 a year. Okay. Now,
So can he make $1,000 a year of his 50,000 on a brokerage account and some other investment?
or
Right.
a name brand savings account right
I
now
like
out
that.
there paying over 4%.
Right.
I mean, 50 grand paying 4% interest right now is $2,000 a year. So you
Yes.
could just in its basic
Just into
form,
a basic
just sitting in
bond.
a savings account, you're
Yeah.
going to make more money in your savings account than you will in this particular situation than the cost of PMI. That to me is a no brainer. If you can stomach the higher payment too, because it's 10% down versus 20% down. So there is a payment differential, right? There's other factors involved, but just the return on that 50 grand,
Yeah.
letting that 50 grand work for you versus putting it down on the property, in this case, made more sense. Of course, probably going to make more like 8 or 10% in his brokerage account, which means $4,000 or $5,000 a year instead of and just paying $1,000 in PMI. So those are some of the scenarios. We might have even touched on that before on another
And
episode.
yeah, and I really like that what what you're talking about is a consultation with a client that figures out their financial goals in order for us to structure the loan correctly for them. It's almost like we love talking to people's financial advisors as well. So, what could they do with that $50,000? Should they put it into the mortgage or should they put it into something that's going to gain more interest than what the mortgage would cost?
Exactly.
And that's the very simple way to say it. And that's why we love, not only talking to the client, but like, do they have a financial advisor that is going to be managing a brokerage account? Is the client just going to manage their own brokerage account? Because we all know cash is king. And if you could have money make money for yourself, it's better than spending it.
That's right. And you could argue, okay, if I'm borrowing more, I'm paying more in interest. Yes, again, and that's also a
Right.
tax deduction if it's an invested property or if it's owner occupied. So there's so many different factors there. We don't want to say like this is a blanket statement. This is what you should do.
Right.
But for this particular client, we evaluated, and that's what we came up with was the best option. Hang on to your cash and finance a little more on the house. So those options exist. To your point, that's why mortgage insurance is there so that you
Mm-hmm.
can keep that extra cash if you would like to, and or maybe a first time buyer who just doesn't have the 20%, right? You don't have to wait till you have 20% to put down to
No.
buy a house. In fact, you don't need any down payment in some circumstances. We're going to talk about that right now. So we'll move over and
Yeah, let's
cover.
move over.
Yeah.
I like it.
So let's talk about FHA. So FHA loans right now are priced a little bit better in the marketplace than conventional. And when I say that, I mean interest rates are just a tick lower than your conventional rates on certain circumstances
And this is
most of
April
the time.
2024, just to
April
date that, because it
2024,
does change.
it does change. Yeah,
Yeah.
it's a good point. There's pros and cons to FHA, and what a lot of our clients do when they gravitate towards an FHA loan
Mm.
is there's several factors, but specifically on the PMI factor, the private mortgage insurance at its maximum is 0.55% per year. So $550 a year per 100,000 that you're financing. Okay.
You'll probably touch on this, but that can
Yeah.
be a lot cheaper than if one person can have a much cheaper mortgage insurance premium on an FHA loan, then they'll have a mortgage PMI loan on a conventional.
That's
Same
right.
person,
That's right.
same application. So, like
And the reason, yeah, no,
yeah,
you're
one
exactly right.
example is I had a client. It was $280 cheaper a month to
Per
have an
month.
FHA program than a
Yeah.
conventional program on their mortgage insurance.
And if that particular
Yeah.
client just jumped online and said, I want a conventional loan, 3%
Right.
down, they would have paid over $3,000 a year
Yeah,
more
it was a lot.
than your guidance
Yeah.
to help them with actually this is a better program, this FHA. Now, having said that,
Yeah.
the objection we get is PMI on FHA loans is for the life of the loan.
Sure.
And that's true if, number one, if you're going to actually pay 360 payments and keep the loan forever,
30
we understand
years, right?
30 years. But it's also if you put less than 10% down, the PMI is for the life of the loan on FHA. If you put 10% or more down, the PMI actually goes away per the amortization schedule when you get to 78% loan to value. So it's not always for the life of the loan, blanket statement. There's so many things in our industry where it's hard to say nevers and
Right.
alwayses. Like there's a lot of if this then this, and so there's not a lot of nevers and there's not a lot of always. Um, but this particular guideline, yes, it's for the life of the loan. If you put less than 10% down, but if you put 10% or more down, then the PMI can come off. Versus conventional across the board, when you have monthly mortgage insurance on an owner occupied or second home property, that mortgage insurance will fall off when you get to 78% technically of the amortization schedule. We're going to talk about how to get it removed though, so I jumped ahead.
Yeah. One thing we also didn't talk about is that there is different companies that offer mortgage insurance at different
True.
prices. Um, so, even though I'm kind of like sideways telling you that, just to have a little transparency in our industry, we shop mortgage insurance. So it doesn't just get paid out to one person. We have options, here at Benchmark. We actually every time we look at conventional mortgage insurance, we're pricing 6 different entities
That's
to
right.
see what that cost could be at each different entity. And believe it or not, each one has different prices.
They do.
And obviously, we're always going to get you the cheapest one because that's what we do.
And,
We
and
shop
there
it for
are
you.
and there are banks out there and mortgage companies out there that do not have access to all
Some only have
six.
like 2, some
It
have
is
3. We have
a
6.
sixopoly. Like there's only 6 companies in the industry max. We do have all 6 here that we work with.
Yeah.
Not all banks do, and so you might be working with another mortgage company that only has 1 or 2 options, and those happen to be significantly higher.
Yeah.
It's possible.
And there could be, I mean, when I say range, I mean one might be twice as much as another one.
Yes,
Like it's
huge.
not even, sometimes it's not even close. Yeah.
It's
Good.
huge. Yeah, that
Okay.
was good that we circled back on that. So again, that was for conventional.
Conventional.
And the FHA pros and cons. Again, you've got a monthly mortgage insurance. Also on FHA, you have an upfront MIP, upfront mortgage insurance premium,
Yep.
which is about 1.75% as of the date that we're shooting this video. It is 1.75% of the loan amount. So if you're borrowing $100,000, it's $1,750. 200,000, it's
That's
3,500
part
ish
of the closing
dollars.
cost.
Yeah, it's a pretty big number. So it gets up there in your $400,000 and $500,000 price points. That upfront mortgage insurance premium is a pretty substantial number. Now it is financed onto the loan amount, and you also have monthly. So FHA,
Right.
you have both. Whereas conventional, typically you have either or, either an upfront premium or you have monthly. You don't have both unless you do that split premium product, which we evaluate at the time that you're applying for the loan. But the FHA premium, even considering the upfront cost and the monthly cost, in many cases, to your point with your recent client, was $280 a month cheaper.
Right.
So how quickly are they going to pay off that upfront premium that they financed? I mean, it probably a year or two.
Yeah.
They kind of covered the cost of that. So that's where someone might tilt to an FHA loan versus a conventional loan because the monthly payment's so critical.
Yeah. And let's completely different question is if you have a conventional loan, you're paid mortgage insurance, you're waiting for it to get to that 78% where it automatically comes off. About how long does that usually take? Is it the 7-year mark?
It's between 7 and 9, I believe.
7 and 9. So it depends on the amortization schedule that gets drafted with your terms, right? And you'll see on the amortization schedule basically like how much is principal, interest, and your balance. And when that balance hits to the 78%, that's where it's at.
Then it automatically comes off.
Yeah.
Yeah. And there's ways to get your private mortgage insurance removed prior to that time. Your property is naturally going to appreciate over time. On average, maybe 3 to 5% appreciation per year. So that's something statistically you can look back on for 30, 40, 50 years, and that's about how properties have appreciated. And then you're also, like you said, you're paying that that mortgage principal amount down. Every single month you make a mortgage payment, your balance is going down. So your property value is going up, your balance is going down again over time. And there is a way to eliminate the private mortgage insurance prior to the amortization
Right.
schedule showing 78%. That is worked out directly with your servicing company. So you contact your servicing company. Hey, I have more than 20% equity. They'll probably have you go through an appraisal process. You might even have to pay for that appraisal, and then they'll order the appraisal. It'll come back. You'll have more than 20% equity, let's say, and there's a process that you go through to get it removed. So we don't want to get too much into that, but can you get it removed prior to the 7 or 8 or 9 years? Absolutely, there is a way. I'm a living testament. I did that on an investment property that I bought, and so was able, or second home, was able to get that mortgage insurance removed prior to the however long it was going to take, 5 or 6 years. And so that's all part of the pre-purchase consult as well.
Right.
Like, what is the end game? What's that strategy that you're looking for? And if this is a property that you know you're going to be in for a long, long, long time, that strategy up front might look a little different than, hey, I'm only going to be here a year or two. And so that's why
Yeah.
it's so important.
And a lot of people, most mortgage insurance come off when a property is refinanced.
That's right.
So when you do a refinance, they're not going to refinance 100% of the property. They're going to go to 80% loan to value, which doesn't include mortgage insurance anymore. So
Yeah.
Go ahead.
Well, right now, that's exactly right. So at the time that we're shooting this, there's so many clients out there in our professionals in our industry and experts that believe over the next 1 to 2 years, we will start to see rates decrease. Exactly when that happens, we don't know. But the combination of home appreciation, paying down some of the principal, rates coming down, it's exactly what the opportunity is going to be, is clients going from a higher interest rate to a lower interest rate, and potentially removing the PMI because it's based on a new appraisal.
Mm-hmm.
It's based on the updated loan amount, which is less in most cases. And so that combination, and maybe using some of those strategies, we can get the PMI removed completely from the next
Right.
loan that you have, which could compound the savings, right? You're saving money on the principal and interest. You're also not paying PMI anymore in that example. And that could be a significant amount per month.
Yeah.
Yeah. So, okay, so that's conventional and FHA. USDA, the unicorn out there.
Guarantee fee.
The guarantee fee. So we have MIP, we have PMI, now we have guarantee fee. USDA is 100% financing. So does stand for United States Department of Agriculture, like the ground beef, that you buy at the store. But it's designed for rural properties. It's a rural housing program. So it's 100% financing. The maps change about every 10 years based on the census. But USDA is designed to give clients an opportunity for 100% loan. They do have a small guarantee fee, call it a mortgage insurance premium, essentially, on a monthly basis. They also have an upfront one. Now, FHA we touched on was 1.75% upfront. USDA is only 1%, so a little less. And then the monthly fee is also less than FHA. It's 0.3%, so $300 a year for every 100,000 that you finance. And so you do have a little bit up front. It's financed onto the loan. You do have a little bit each month. The interest rates are somewhat in line with FHA and VA rates. And it's a great program. Obviously, we're threading the needle.
I wish it was everywhere. The
Yeah.
problem that arises is a lot of people think that it is everywhere. It is geographic. So you can go onto their website and look at the map. If the property you want is not on that map, you can't get a USDA loan for it.
Yeah.
If it is on the map, it could be available.
That's right. Yeah, just Google USDA eligibility map. There's a map that pops up. Like you said, put the address in, hit submit. It'll tell you if it's eligible. Not 100%. It's probably 99.9% accurate.
Wait, technology's
the
not
challenge
perfect?
is when it's on the line, because it's like
Yes.
those houses across the street are USDA eligible. Those houses on the other side of the street are not. It's super kind of quirky on that regard. But yeah, the USDA map. So we go through that exercise with clients. And just recently, I'll tell you, we compared a VA with the USDA because the veteran the property was also USDA eligible. The veteran wanted just to see both options. VA blew it away.
Yeah.
By several $100s a month.
VA products are amazing.
And so the VA product is kind of the last one when it comes to PMI, and there's no PMI on VA. So we talked about FHA, we talked about conventional. USDA has a smaller amount of monthly mortgage insurance, you could say, even though it's called a guarantee fee. And then VA has zero. So VA for our veterans, our eligible active military out there, you are getting 100% financing, and there's no PMI and for the life of the loan. And it's really the best loan out there if you can qualify
Yes.
for it, and rightly so, for our veterans and active military. So thank you for your service as well. So that really kind of covers the four options. Now, jumbo products, depending on the scenario, could also have mortgage insurance. That's going to fall under conventional. It's just going to fall under the same types of mortgage insurance you have for conventional. So,
Yep. And non-qualified mortgages don't have mortgage insurance.
correct. They do not.
So things that are out of the box, not your usual run of the mill, sometimes those don't have it. That's why they require more down, usually, traditionally.
That's right. Yeah, and even if you're financing over 80% on a non-qualified mortgage, like a bank statement program or something like that, the mortgage company is doing something what's called self-insuring the loan. They're probably buying a mortgage insurance policy on your behalf. You're not really paying for it, but maybe it's factored into the interest rate, maybe it's sort
Right.
of factored into the term, but it's not part of the monthly.
Right.
But the bank's going to make sure that they're covering themselves in
Right.
case they had to take the
That's
property
good to know.
back. Yeah. So that's PMI. Like I said, PMI
It's
is
not a
four-letter.
four-letter
It's not a
word.
four-letter word.
It's good.
Well, I think we covered a lot. Appreciate you guys being with us again today. So many questions could come from this. We welcome those questions. Please give us your thoughts, feedback, comments, and please share and subscribe. And shout out to our new subscribers recently. We're now up to about 120 subscribers. So we are excited to bring this content to you and appreciate you guys.
Thank you all. Have a good day.
Take care.